Let's be real. When it comes to tech stocks, the market can feel like an absolute roller coaster. One minute you're soaring, the next you're plunging. But what if you could actually spot the signs of a dip before it happens? Well, that's exactly what we're going to break down today. How to find the real, meaningful signals that are hiding in all that market noise. So, let's start with the one question every single tech investor has to ask themselves, and you got to be honest. Are my investments built on solid fundamentals, or are they just riding a wave of hype? Because trust me, when the market starts to turn, the answer to that question makes all the difference in the world. And that's the perfect lead into our first section, learning to separate the noise from the signal. In the chaotic world of tech investing, this is probably the single most critical skill you can have. Okay, first things first, let's get our terms straight. What are we even talking about here? A market correction. Now, this is not a crash. Not at all. Think of it more like a reset button. It's what happens when stock prices get way ahead of themselves. They climb too far, too fast, and the market just kind of pulls them back to reality. It can actually be a healthy, even necessary thing. And this distinction right here is absolutely key. A correction is a reset. A crash is a full-blown crisis. You have to understand this because it's the difference between making a strategic reevaluation and just panic selling everything. And you'll see corrections almost always follow these intense periods of hype, which makes them the perfect time to check in and see what's real. Now, the good news is, these corrections, they rarely just appear out of thin air. They leave clues behind. You might start to see quarterly growth slowing down, or you'll see a stock price that's just completely unmoored from the company's actual earnings. When the whole story is being driven by splashy headlines instead of hard data, that is a major, major warning sign, especially for those smaller, more volatile tech stocks that are the most vulnerable. Okay, so where do we actually find this solid data? Well, that brings us right to section 2, the 3 vital signs. I want you to think of these as your personal diagnostic toolkit for checking on the financial health of any company. First up, we have the most fundamental metric of them all, revenue growth. Before anything else, we have to ask the simplest question. Is the company actually making more money? Is it winning new customers? Is it expanding its reach? It all starts right here. And the source material just puts this perfectly. For those small tech companies that are basically running on hope and hype, a steady drop in revenue is one of the clearest, earliest red flags you will ever see. It's often the very first sign that the story is starting to crumble. But here's the thing. Growing revenue is only half the battle. And that brings us to our second vital sign, the earnings report. And when you look at these, the big headline number, honestly, that's the least interesting part. We need to dig a whole lot deeper. Right. The real question is, how did the company hit its earnings target? Was it through genuine, sustainable growth? Or did they just slash their R&D budget, delay a big product launch, or get a little too creative with the accounting? Because profits that come from cuts, not from customers, are a massive sign of a business that's in trouble. And finally, our third vital sign. This is the one that connects a company's actual performance to its stock price, valuation ratios. Really, these are all about asking one very simple, very direct question. Does this stock price even make any sense? Exactly. Ratios like price to earnings, which is basically just what the market is willing to pay for every dollar a company earns, are an incredible reality check. When you see a PE ratio that's just through the absolute roof, it's a huge signal that optimism has completely detached from reality. And that's often when a correction steps in to bring things crashing back down to earth. So let's just quickly tie these 3 vital signs together. Revenue growth tells you if the business is actually expanding, the earnings report shows you how it's making a profit, and valuation ratios tell you if the price is even justified. Now look, a red flag in just one of these might be a fluke, right? But when you start seeing warning signs across 2 or all 3, that's when you really need to start paying close attention. Okay, so once you've gotten the hang of the big 3, it's time to go a little deeper. Welcome to Section 3, Reading Between the Lines. This is where we learn to find the subtle patterns that tell the real story. These are the sneaky signs that often pop up long before the damage actually hits the official earnings report. You gotta look at the fundamentals. Are their costs growing faster than their revenue? Are profit margins shrinking quarter after quarter? Then look at the users. Are they less engaged? Are clients starting to leave? Heck, even something like a sudden unexplained executive departure can be a huge early warning. These are the details that tell the story behind the numbers. And this slide really just captures the core issue perfectly.
It's a tale of two companies, right? On one side, you've got companies built entirely on buzz. Their value is tied to some hot new trend, but they don't have real products or real results. Then you've got companies built on an actual business. They have real users, proven results, and a focus on the fundamentals. So, when a correction hits, which one of those do you think is more likely to survive?
So now we can read the signs, both the obvious ones and the subtle ones. But all that knowledge is pretty useless without a plan. And that brings us to our final section, Section 4, From Analysis to Action. How do you actually use all this information? Here is a simple but incredibly powerful framework. Step 1. For each company you follow, just pick one or two key metrics that matter most. Step 2. Check in on them every single quarter, not just when the market is going crazy. Step 3. Always be on the lookout for the gap between the story a company tells and the results it actually delivers. And finally, Step 4. Based on that gap, you adjust your position. See, this framework turns you from a passenger just reacting to the market into a pilot who's making informed decisions.
Ultimately, it all comes down to this one simple truth. You are not trying to predict every single swing in the market. That's a losing game. The real goal is to ground your decisions in reality, to constantly balance the exciting story you hear with the cold, hard data you can prove. So we'll end with a final question for you to really think about. Looking at your own process, at your own strategy, is it truly prepared for what the data might say next? Because in a volatile market like this, being prepared isn't just a defense, it's everything.